If you're in your 30s and still not investing, this mistake is costing you years of freedom. Your 30s are the most powerful decade to build wealth, if you do it correctly. In this video, I'll show you exactly how to use this decade to quietly build real wealth. Start with simple, boring investments, because boring is what builds real wealth. Consistency matters more than cleverness, and broad, low-cost investments give you the best chance to grow without unnecessary stress. By focusing on steady contributions, diversification, and long-term growth, you allow compounding to do the heavy lifting while you focus on your career, family, and life. For most people, the best place to start is an S&P 500 index fund. Vanguard is a great starting point. They have low-cost index funds and exchange-traded funds to meet your risk tolerance and time horizon. A good rule of thumb is to save 10 to 20% of your income, automate it monthly, and increase it every time your income increases. Investing $500 a month from age 30 to 65 could grow into over $1 million over time, earning an average of 8% per year. Compounding doesn't need perfection, it needs patience. Investing in home ownership in your 30s can be a powerful wealth-building move because it combines stability, leverage, and long-term growth at a stage of life where your income is usually more predictable. Instead of paying rent with no return, each mortgage payment builds equity, an asset that can grow over time and support future goals. Property also acts as a forced savings mechanism, offers protection against rising housing costs, and can provide lifestyle security for you and your family. Over the long term, home ownership can complement other investments by diversifying your wealth beyond shares and cash. Begin by getting clear on your numbers, understand your income, expenses, and how much you can realistically borrow without stretching yourself. Save for a deposit, even if it's modest. Factor in additional costs like taxes, monthly bills, and maintenance. Speak to a broker or lender in your area to understand your options. Start with a property that fits your current life, not your dream life. Something affordable, well located, and aligned with long-term demand. In your 30s, the goal isn't to buy the biggest house possible. It's to buy a solid asset that grows with you while keeping your finances flexible. Having an emergency fund in your 30s is one of the smartest financial moves you can make. An emergency fund protects you from unexpected events like job changes, medical costs, or urgent repairs. It gives you breathing room, reduces stress, and most importantly, stops you from having to rely on credit cards or sell investments at the wrong time. A strong rule of thumb is to set aside 3 to 6 months of essential living expenses. If your income is stable, 3 months may be enough. If your income fluctuates, you're self-employed, or you have dependents, aim closer to 6 months. Keep this money in a high-interest savings account where it's easy to access but separate from everyday spending. An emergency fund isn't about earning high returns. It's about creating financial security so the rest of your wealth-building plan can grow uninterrupted. Budgeting in your 30s is essential. Without a clear budget, it's easy for money to disappear, leaving little room for saving or investing. A budget isn't about restriction, it's about direction. It helps you intentionally allocate your income toward what matters most, like building wealth, security, and flexibility for the future. Start by understanding your monthly numbers: income, fixed expenses, variable spending, and savings. Prioritize paying yourself first by allocating money to investments, emergency savings, and long-term goals before discretionary spending. Keep the system simple. Use broad categories, automate bills and savings, and review your budget monthly rather than obsessing daily. The goal of budgeting is clarity, not perfection. Taking advantage of retirement accounts in your 30s is one of the smartest financial moves you can make because this decade sits at the perfect intersection of time, income, and compounding. You're typically earning more than in your 20s, but still have decades before retirement, which means every dollar you contribute now has time to grow multiple times over. Retirement accounts also come with tax advantages, allowing more of your money to stay invested and compound, rather than being lost to tax each year. Start by understanding the retirement system available to you. Aim to contribute regularly and increase contributions whenever your income rises. Take full advantage of employer matches or concessions. Choose diversified, low-cost investment options, and resist the urge to constantly change strategies. In your 30s, the goal isn't to maximize returns aggressively, it's to maximize consistency and time in the market, letting your retirement accounts grow quietly in the background while you build the rest of your life. Saving for your kids' education in your 30s is important. Education costs tend to rise faster than inflation, and starting early reduces the pressure you'll feel later when expenses peak. Instead of scrambling when fees are due, you can make calm, intentional decisions about schooling options and support your children without taking on unnecessary debt. Importantly, saving in your 30s lets you balance education funding alongside other priorities, like investing, home ownership, and retirement, so no single goal overwhelms the rest. It's not about covering every dollar of their education, but about giving your children options while protecting your own financial future. Avoiding lifestyle creep in your 30s is crucial because this is often the first decade where your income starts to rise meaningfully, and how you handle that increase can determine your long-term financial freedom. Lifestyle creep happens when higher earnings automatically turn into higher spending, leaving your savings and investments unchanged. On the surface, everything looks fine, but behind the scenes, you're missing the chance to build real wealth during one of your most powerful compounding decades. By consciously keeping your lifestyle stable while your income grows, you create surplus, and surplus is what funds investing, home ownership, education savings, and long-term security. Avoiding lifestyle creep doesn't mean denying yourself enjoyment. It means choosing freedom over appearances and using your 30s to quietly build a life with more options and less stress. Your 30s are the decade where intention turns into momentum. You're no longer just experimenting, you're building. By investing consistently and focusing on long-term growth over short-term noise, you give yourself the gift of options in your 40s, 50s, and beyond. You don't need to time the market or chase every trend. You just need patience, discipline, and a clear plan you can stick to. Start where you are, invest what you can, and let time do the heavy lifting. Because the decisions you make in your 30s won't just shape your portfolio, they'll shape your freedom. Thanks for watching. Until next time, keep earning, keep saving, and keep investing.